Some say Bitcoin is faith, the future, an opportunity, and the greatest financial innovation in human history. Others say Bitcoin is a scam, a bubble, a trap, and the digital world's Ponzi scheme. But whether you support it or criticize it, the emergence of Bitcoin has fundamentally changed humanity's understanding of currency, finance, and wealth. Over the past 16 years, Bitcoin's price has experienced several massive fluctuations, surging from fractions of a cent to a peak of over $126,000 in October 2025, an increase of well over 10 million times. It has created countless myths of overnight wealth and also left behind countless stories of devastating losses and liquidations. What kind of capital wrestling is truly hidden behind these thrilling rises and falls? In the brutal battle where institutions now collectively hold billions in Bitcoin through sophisticated financial instruments, and where retail traders continue to face liquidation cascades, who is the real beneficiary? Today, let us step into the capital world of Bitcoin and unveil the truth behind this cruel game. Before discussing the Bitcoin capital war, we must start with its birth. Rewind to 2008, when the world was experiencing a once-in-a-century financial tsunami. Countless people lost their life savings due to the greed of Wall Street and the excessive issuance of currency by banks. It was against this backdrop that a mysterious figure under the pseudonym Satoshi Nakamoto published a paper titled Bitcoin, a peer-to-peer electronic cash system. In this paper, Nakamoto proposed a brand new concept: decentralized digital currency. The Bitcoin system he designed is completely free from the control of central banks and governments, using blockchain technology and cryptographic algorithms to ensure the security and transparency of transactions. Anyone can obtain Bitcoin through mining, and the total supply of Bitcoin is limited to 21 million coins, which fundamentally prevents the risk of overissuance and inflation. On January 3, 2009, Satoshi Nakamoto mined the first block of Bitcoin, which we call the Genesis block, and left a profound message within the block. The Times 03, Jan 2009, Chancellor on brink of second bailout for banks. This quote not only revealed the historical context of Bitcoin's birth, but also established Bitcoin's anti-establishment and anti-inflationary DNA. Bitcoin's real rise began in 2013. With the outbreak of the Cyprus financial crisis, people's trust in the traditional financial system began to waver, and Bitcoin began to gain traction as a safe haven asset and a tool for resistance. In that year, the price of Bitcoin first broke the $1,000 mark. But what followed was the collapse of the Mt. Gox exchange, with a large number of Bitcoins stolen, dealing a heavy blow to the market. Consequently, Bitcoin's price plummeted, entering a bear market that lasted 2 years. However, true capital predators never miss an emerging wealth creation myth. In this Bitcoin capital war, there are distinct phases of players who have, at different stages, driven the exponential rise in Bitcoin's price. These phases include Wall Street financial giants transitioning from skepticism to embrace, tech billionaires weaponizing social influence, and mega-cap institutions building strategic reserves. The first wave, Wall Street's institutional embrace and the ETF revolution. In 2017, when Bitcoin emerged from its trough and headed toward $20,000, traditional financial institutions on Wall Street began to take notice. They no longer saw Bitcoin as a clown, but as an asset that could be packaged, traded, and profited from. Through financial derivatives like futures contracts, they introduced Bitcoin into mainstream markets. However, the true game changer came in January 2024, when the SEC approved spot Bitcoin ETFs, a watershed moment that legitimized Bitcoin as an institutional asset. BlackRock's iShares Bitcoin Trust, IBIT, alone accumulated over $244 billion in assets. By October 2025, all Bitcoin ETFs collectively held over 1.35 million Bitcoin, more than Satoshi Nakamoto himself. BlackRock emerged as the dominant player, acquiring over 800,000 Bitcoin by October 2025, representing roughly 4% of all Bitcoin that will ever exist. These institutions leverage their massive influence to issue bullish or bearish reports, creating market panic or frenzy, thereby harvesting retail investors from both ends. The second wave, Silicon Valley's social media manipulators and presidential connections. After the institutional foundations were laid, the tech elite stepped onto the stage with unprecedented influence. The most representative figure is Elon Musk, whose manipulation of Dogecoin demonstrated the power of a single individual with 200 million followers to move billions in market capitalization. A single tweet from him can instantly cause market capitalization fluctuations of tens of billions. Following Trump's 2024 election victory, Musk became an integral part of the president-elect's inner circle as head of the Department of Government Efficiency, granting him even more influence. His backing of Dogecoin propelled the meme coin from the 8th largest cryptocurrency to 6th place. This group often appears as technology evangelists and visionary advocates. Their goal is not entirely about technological innovation, but rather to attract millions of followers into the market through viral hype, allowing them to profit at the peak. The epic surge in Bitcoin and crypto markets following Trump's victory in November 2024 was inseparable from this coordinated narrative of a crypto-friendly administration. The third wave, corporate Bitcoin maximalists and government digital asset stockpiles. The newest and perhaps most powerful player is emerging, mega-cap corporations and nation-states. MicroStrategy, rebranded simply as Strategy in 2025, transformed from a software company into the world's largest corporate Bitcoin holder. In an unprecedented buying spree, the company accumulated 638,000 plus Bitcoin by September 2025, roughly 3% of the entire Bitcoin supply, worth approximately $76 billion. The company's CEO, Michael Saylor, has become the poster child for corporate Bitcoin conviction, raising billions through share issuance and debt to fuel endless accumulation through all market cycles. Even more dramatically, President Trump issued an executive order in March 2025, establishing a U.S. strategic Bitcoin reserve, positioning Bitcoin as a national strategic asset alongside oil and gold reserves. Harvard University and Brown University joined institutional investors by acquiring Bitcoin through ETFs. This fundamental shift, Bitcoin transitioning from speculation to strategic reserve status, represents the final consolidation of Bitcoin wealth among the most powerful entities on the planet. These players control vast tracts of Bitcoin supply, major platforms, and can directly manipulate prices through coordinated announcements, large transactions, and policy changes. The Bitcoin capital war has evolved beyond a zero-sum game into a hierarchical wealth extraction system. What we're witnessing is not random market volatility, but precisely orchestrated capital flows. The sophisticated machinery now operates as follows. Retail investors, harboring dreams of getting rich overnight and lacking professional knowledge and risk awareness, enter the market with their life savings, even borrowed money. They create volatile price action that mega-cap institutions use to load positions at depressed prices. When institutions are positioned, coordinated bullish news, positive regulatory announcements, billionaire endorsements, government strategic reserve policies creates a frenzy. Retail FOMO accumulation pushes prices to unsustainable levels. At the peak, institutions begin liquidating. Derivatives markets create cascading liquidation events when prices drop just 3 to 5%. Contract liquidations trigger algorithmic selling, causing further price declines. In H1 2025 alone, crypto hacks exceeded $2.37 billion in losses, with centralized exchanges remaining vulnerable. Major 2025 breaches included a $165 million CoinEx hack in February and a $90 million Binance breach in March. The original Mt. Gox disaster has been superseded by far more sophisticated manipulation mechanisms. Wash trading, pump and dump schemes, and oracle manipulation now plague the market systematically. In 2024, approximately 3.59% of all tokens launched displayed patterns linked to pump and dump schemes. On decentralized exchanges, an estimated $187 billion in wash trading volume was detected in 2024 alone. These aren't accidents. they're manufactured market conditions designed to extract maximum wealth from uninformed participants. Every violent price fluctuation is not a random event, but a precisely planned, targeted harvest. The ones being harvested are always the ordinary retail investors who lack information parity. They cannot see the private trades, the institutional positioning, the regulatory changes planned weeks in advance, or the social media campaigns coordinated months ahead. They only see the final cascading price movement and the zeroed-out accounts. In this digital arena characterized by information asymmetry, regulatory capture, and centralized market infrastructure, the giants have constructed a never-lose system through information advantage, technical advantage, and capital advantage. The tragic illustration, FTX, once the third largest crypto exchange valued at $32 billion, collapsed in November 2022 when founder Sam Bankman-Fried was revealed to have stolen $8 billion in customer deposits. Bankman-Fried was sentenced to 25 years in prison in 2024, with customers still fighting to recover their assets years later. His collapse damaged an entire industry's credibility, yet institutional players only grew stronger afterward, consolidating market share and influence. Bitcoin was created to resist the centralized financial system, but ironically, its development has fostered an even more hidden and powerful digital centralized power. The concentration of Bitcoin holdings by institutions is staggering. Mega-cap ETFs, MicroStrategy, wealthy individuals, and government entities now collectively hold an enormous percentage of the supply. Satoshi's original vision of peer-to-peer electronic cash has been transformed into a digital reserve asset controlled by the most powerful institutions on Earth. So, who are the real beneficiaries of this capital war? The answer is the few giants who possess absolute information, capital, and technical superiority. Wall Street's BlackRock, not retail investors. Silicon Valley's Elon Musk and his close ties to political power, not ordinary traders. MicroStrategy's Michael Saylor and mega-cap corporations with access to unlimited capital, not savings account holders. The Trump administration and its strategic Bitcoin reserve, not everyday citizens. They never talk about faith, they only talk about profit. To complete the picture of modern capital warfare, the regulatory framework has become another tool of consolidation. In 2024, the markets in crypto assets regulation, MiCAR, in Europe banned pump-and-dump schemes, but regulatory frameworks rarely prevent institutional-scale manipulation. In the US, the approval of spot Bitcoin ETFs didn't democratize Bitcoin, it institutionalized it. The SEC's new streamlined approval process, 75 days versus the previous 270 days, accelerated institutional ETF launches while retail investors remained on the sidelines. Proposed legislation like the Bitcoin Act would allow the US Treasury to directly purchase 1 million Bitcoin, acquiring approximately 5% of the total Bitcoin supply, a government-scale position that would dramatically increase the concentration of wealth and control. Bitcoin has become not just a financial asset but a geopolitical weapon, with governments and mega-cap institutions racing to accumulate reserves. For ordinary people, the emergence of Bitcoin is like Pandora's box. It brought hope, the promise of a decentralized currency beyond government control, an escape route from currency debasement, a hedge against inflation, but it also brought immense greed, systemic risk, and unprecedented predatory mechanisms. For those who want to enter the market, you must understand that you are not facing a fair playing field, but a carefully designed extraction system. You are competing not against other retail traders, but against multi-billion-dollar institutions with teams of data scientists, billionaires with unparalleled media influence, exchanges that profit from your liquidations, government actors with trillion-dollar treasuries, systems of financial leverage that can liquidate your position with a 3% price move. In this market, knowledge is your only barrier, not against risk, but against catastrophic loss. But even knowledge is insufficient without capital reserves to weather the volatility that institutions deliberately create. Finally, this is not a moral judgment, but a structural observation. The accumulation of wealth in Bitcoin, once imagined as the path to financial liberation, has become another mechanism for concentrating wealth and power among the elite. The future of Bitcoin, whether as grassroots currency, institutional reserve asset, or elaborate wealth extraction machine, remains to be written. For those who persist in this market despite these realities, understand the game you are playing, maintain a clear mind, manage your risk ruthlessly, and remember, the accumulation of wealth is never an overnight miracle. True financial security stems from a deep understanding of value, a realistic assessment of your position in the hierarchy of this capital war, and an unwavering reverence for risk.